There's a number that's been hiding in plain sight for 3 decades. 237%. That's Japan's government debt relative to the size of its entire economy. For context, when the United States hit 125%, economists called it a national emergency. Japan is nearly double that. And for 30 years, the world watched this number climb higher and higher year after year, while Japanese bond markets stayed calm, unnaturally calm, artificially calm. On January 21st, 2026, that calm shattered in 6 hours. The 40-year Japanese government bond yield spiked 25 basis points in a single trading session. If you don't follow bond markets, that sentence might sound technical and boring. It's neither. In the Japanese bond market, yields on that maturity typically move by fractions of a single basis point per day. Sometimes it takes months to see a 10 basis point shift. They moved 25 in one afternoon. The 30-year yield jumped 30 basis points, hitting 3.9%, the highest level ever recorded. The 10-year yield surged to 2.35%, a level not seen since 1999. This wasn't volatility. This was rejection. Bond markets looked at Japan's debt load, looked at the government's latest promises, and said no, violently. And here's what makes this moment different from every other bond market tantrum you've ignored over the past decade. Japan holds over $1 trillion in United States Treasury securities. They are the largest foreign owner of American government debt. When Japanese yields spike high enough to compete with US Treasury yields, Japanese investors have zero incentive to keep buying American bonds. Same return, no currency risk if they stay home, so they sell. And when the largest foreign buyer becomes a net seller, US yields don't stay stable. They spike too. The 10-year US Treasury yield jumped 6 basis points the day after Japan's bond market collapsed. The 30-year moved even more. That's not coincidence. That's contagion. That's the transmission mechanism activating. And what started as a Japanese fiscal crisis is now repricing every asset on the planet. Because every stock, every bond, every piece of real estate, every financial instrument in every market is valued relative to risk-free interest rates. When those rates explode higher, everything else reprices lower, mechanically, mathematically, unavoidably. $4 trillion. That's the conservative estimate of global asset value that's about to be liquidated. Not over years, over weeks, possibly days. And the sequence that's unfolding right now, starting this weekend with Japan's snap election on February 8th, has played out 17 times in modern financial history. Every single time a developed economy with unsustainable debt loses bond market confidence, the same 4 stages unfold: setup, dependency, break, contagion. We are currently between stage 3 and stage 4. The break has happened. The contagion is beginning. And if you understand the pattern, if you see how this is resolved every other time, you know exactly what comes next. More importantly, you know what to do before the cascade accelerates beyond control. Because this isn't a story about Japanese fiscal policy. This is a story about what happens when the mathematics of debt finally overwhelm the politics of denial. And right now, in real time, we're watching that collision play out across the world as 4th largest economy, with direct transmission lines into every major financial market on Earth. To understand why this moment was inevitable, you need to understand the architecture that made it possible. Japan didn't arrive at 237% debt to GDP overnight. This took 30 years of deliberate policy choices, each one seemingly rational in isolation, each one adding another layer of structural fragility. It started with the collapse of Japan's asset bubble in 1990. The Nikkei stock index had reached 39,000. Real estate values had become so absurd that the grounds of Tokyo's imperial palace were theoretically worth more than the entire state of California. When that bubble burst, the Nikkei fell 75% over 13 years. Property values dropped 60 to 80% in major cities. The Japanese government faced a choice: let the system purge the excess, accept a painful but cleansing recession, and rebuild from a stable foundation. Or intervene, prop up failing banks, launch massive stimulus programs, prevent the market from clearing. They chose intervention, aggressive, sustained, debt-financed intervention, infrastructure projects that went nowhere, bank bailouts that preserved zombie companies, stimulus packages layered on top of stimulus packages. Japan's government debt to GDP ratio was 50% in 1990. By 2003, it had tripled to 150%. And the economy still hadn't recovered. Growth remained anemic. Deflation set in. The interventions didn't work, but they did create something: dependency. The entire system became dependent on government spending, on artificially low interest rates, on the Bank of Japan suppressing bond yields to keep borrowing costs manageable. Because here's the mathematical trap Japan built for itself. When your debt is 50% of GDP and interest rates are 2%, your annual interest cost is 1% of GDP. Painful, but sustainable. When your debt reaches 150% and rates are still 2%, your interest cost is 3% of GDP. Uncomfortable, but still manageable. But when your debt hits 237%, even 1% interest rates mean annual interest costs of nearly 2.4% of GDP. That's before paying down any principal. That's before funding any government programs. Just interest. If rates rise to 4%, which is where Japanese long-term bond yields are heading right now, the annual interest cost becomes 9.5% of GDP. Japan's entire government budget is roughly 40% of GDP. 9.5% of that would go to interest alone. Nearly a quarter of all government spending would be debt service. That's not sustainable. That's not manageable. That's a debt trap. So over the past 8 years, the Bank of Japan implemented something called yield curve control that explicitly capped the 10-year government bond yield at 25 basis points. How? By promising to buy unlimited quantities of bonds at that price. If yields tried to rise above the target, the Bank of Japan would step in and buy however many bonds it took to push yields back down. For 8 years, this worked. Japanese bond yields stayed artificially suppressed. The government could borrow at near zero rates despite having the highest debt burden in the developed world. By the end of yield curve control, the Bank of Japan owned over 50% of all Japanese government bonds outstanding. Not private investors, not pension funds, not foreign buyers, the central bank. When your central bank has to own half of your government's debt to keep the system functioning, you're not operating in a market anymore. You're operating in a control regime. If you're finding value in this level of analysis, in understanding not just what's happening, but why the system was designed to break this way, hit the like button. Because what comes next shows you exactly how that control regime failed, and why the failure is spreading faster than almost anyone predicted. And then in March 2024, the Bank of Japan blinked. They ended negative interest rates for the first time in 8 years. They started normalizing policy, reducing bond purchases, letting market forces play a larger role. The message was clear. Japan was transitioning away from emergency crisis management toward normal monetary policy. Bond markets tested that commitment immediately. Yields started rising. Slowly at first, the 10-year yield moved from 25 basis points to 50, then to 75, then past 1%. The Bank of Japan let it happen. They wanted higher yields. They thought controlled normalization was possible. They thought they could manage the transition. They were wrong. January 20th, 2026. Japanese Prime Minister Saiga Takai made an announcement that detonated the bond market. She called a snap election for February 8th and outlined her campaign platform. Suspend the 8% consumption tax on food. Increase government spending. More stimulus, more benefits, more support for voters. On the surface, this sounds like standard election year politics. Promise voters what they want, worry about paying for it later. But Japan isn't a standard economy. Japan is the most indebted, developed nation on the planet, running persistent deficits, with a central bank that just spent 8 years suppressing borrowing costs to keep the system solvent. And the Prime Minister just promised to cut taxes and increase spending with no identified funding source. Bond markets understood what that meant instantly. More debt issuance, more bond supply hitting the market, more borrowing at a moment when the Bank of Japan was stepping back, when private investors were already questioning sustainability. The math didn't work. The promise wasn't credible, and the response was immediate. January 21st. The Japanese government bond market experienced the most violent repricing since the United Kingdom's Liz Truss crisis in September 2022. Yields across the entire curve spiked simultaneously. Not just long-term bonds. Everything. The 2-year yield jumped. The 5-year. The 10-year surged to 2.35%. The 30-year hit 3.9%. The 40-year yield, the longest maturity Japan issues, spiked 25 basis points in 6 hours. But it wasn't just one session. January 22nd, another weak bond auction. The 20-year maturity couldn't find buyers at any reasonable yield. Investors demanded higher rates to absorb the supply. More selling cascaded through the market. Yields kept climbing. By January 28th, the United States Treasury Secretary Scott Bessent was calling his Japanese counterpart. The concern was explicit. Japan's bond market instability was starting to affect U.S. markets. By February 3rd, just 3 days ago, Japan held another 10-year bond auction. The yield came in at 2.25%, 40 basis points higher than the December auction. Demand was deteriorating. The bid-to-cover ratio was weak. Foreign investors were reducing exposure. Domestic banks were pulling back. Insurance companies were diversifying away from Japanese government bonds. This is the break. This is stage 3. And here's what makes it irreversible. Confidence, once lost in sovereign debt markets, doesn't return easily. It doesn't return because a politician gives a reassuring speech. It doesn't return because a central bank promises support. It returns only when the underlying mathematics change. When debt levels fall, when deficits shrink, When fiscal credibility is restored through action, not promises, Japan can't reduce its debt burden quickly. 237% debt to GDP does not fall to 100% in a year or even 5 years. It would require sustained primary surpluses, economic growth exceeding borrowing costs, and political will to cut spending or raise taxes significantly. Japan has none of those things. Their economy has been stagnant for 3 decades. Their population is aging and shrinking, which means fewer workers supporting more retirees. Their political system is structurally incapable of making the spending cuts required. So the bond market is doing what bond markets always do when confidence breaks. It's repricing the risk. It's demanding higher yields to compensate for the probability of default, restructuring, or inflation. And those higher yields make the debt trap worse. Because when Japan has to refinance $13 trillion in debt at 4% instead of 1%, the interest cost triples. That forces either more borrowing, which pushes yields even higher, or spending cuts so severe they trigger recession, which also pushes yields higher because recession reduces tax revenue and increases deficit spending. There's no clean exit, there's no easy path, there's only pain. The only question is what form the pain takes and who bears it. And the transmission mechanism to global markets is already active. Japanese investors are looking at domestic bond yields of 2.25% on 10-year maturities, nearly 4% on 40-year maturities, and comparing them to US Treasury yields. For years, Japanese institutions bought US Treasuries because they offered higher yields than Japanese bonds. 2 or 3% looked attractive when Japanese yields were 0 or negative. But now, Japanese bonds offer similar or better yields in yen with no currency risk. The math is simple. Sell US Treasuries, buy Japanese government bonds, repatriate capital. And that's exactly what's happening. The evidence is in US Treasury yields, which have climbed from 4.1% on the 30-year in early January to 4.35% today. 15 basis points in less than a month on a $30 trillion treasury market, that's hundreds of billions in lost value. Here's what almost nobody is saying publicly, what the financial press is dancing around, what central bankers are privately terrified of. This isn't containable. When the world's 4th largest economy, holding over $1 trillion in US Treasuries, experiences a sovereign debt crisis, the idea that it stays confined to Japanese markets is fantasy. Modern financial markets are interconnected through thousands of transmission channels, currency markets, derivative markets, cross-border banking flows, pension fund allocations, sovereign wealth fund positioning. Every major institution in every developed economy has exposure to this crisis either directly or through second and third order effects. And the contagion follows a specific sequence that's repeated itself every single time this has happened before. United Kingdom, September 2022. Prime Minister Liz Truss announced £45 billion in unfunded tax cuts. UK government bond yields exploded 100 basis points in 3 days. Pension funds faced margin calls on their leveraged bond positions. They were forced to sell bonds to meet those calls, which pushed yields even higher, which triggered more margin calls. A doom loop. The Bank of England had to intervene with unlimited bond purchases to prevent systemic collapse. Truss resigned after 44 days. Sterling crashed to near parity with the dollar. The UK housing market froze as mortgage rates spiked from 3% to over 6%. Wealth transferred from homeowners to cash holders, from bond investors to those who saw it coming and positioned accordingly. Greece, 2010 to 2015. The government revealed its budget deficit was actually 12.7% of GDP, double what had been reported. Bond yields spiked from 5% to over 21% within months. Greece required 2 massive bailouts totaling 240 billion euros. Even with that support, they were forced into the largest sovereign default in history. Private bondholders took a 75% loss. The Greek economy contracted 25%. Unemployment hit 27%. An entire generation saw their wealth destroyed while German banks and hedge funds that had positioned correctly made fortunes. The pattern is identical every time. A government with unsustainable debt makes a policy announcement that bond markets view as fiscally irresponsible. Yields spike. The higher yields make the debt burden worse. More selling follows. Currencies crash. Central banks intervene, but intervention only works temporarily unless the underlying fiscal problem is solved. And the fiscal problem is never solved quickly because it requires political will that does not exist until crisis forces it. Japan is in that sequence right now. And the transmission to US markets, to European markets, to global equity markets is mechanical. Japanese investors are net sellers of over $1 trillion in US Treasuries. That's supply hitting the market. Supply pushes prices down and yields up. Higher US Treasury yields mean higher borrowing costs across the American economy. Corporate bonds reprice, credit spreads widen, mortgage rates rise, stock valuations compress because the discount rate for future earnings increases. The S&P 500 is trading at 22 times forward earnings. That's elevated by historical standards. Normal valuation is closer to 18 times, but that's at stable interest rates. When 10-year Treasury yields move from 4% toward 5%, which is the trajectory we're on, fair value on equity markets is probably 16 times earnings. That's a 27% decline from current levels. On a $45 trillion US equity market, that's $12 trillion in nominal losses. Add in European equities, Asian markets, emerging markets, add in bond market losses as yields rise globally, add in real estate repricing as mortgage rates spike, add in currency devaluations cascading through countries with dollar-denominated debt. The $4 trillion estimate isn't pessimism, it's arithmetic. And if stage 4 fully unfolds the way it has historically, 6 to 8 trillion in global asset liquidation is not only possible, but probable. Now, here's the question nobody in mainstream financial media is asking, the question that should fundamentally change how you think about portfolio construction, about risk, about what safety actually means in this environment. If the largest foreign holder of US debt is now a forced seller, if bond markets are repricing sovereign risk across developed economies simultaneously, if central banks have already exhausted most of their traditional tools over the past 15 years of crisis management, what exactly stops this cascade once it reaches critical momentum? Think about that carefully. Then look at your portfolio allocation. Look at your exposure to long-duration bonds, to equities at 22 times earnings, to real estate financed at rates that are about to reset higher, to emerging market assets denominated in currencies that are about to get crushed. And ask yourself, am I positioned for what's coming, or am I positioned for what I hope continues? Because hope is not a strategy when the pattern is this clear and the mechanism is already in motion. The wealth transfer that is beginning right now isn't happening in some distant market that doesn't affect you. It's happening to your retirement accounts, to your savings, to the purchasing power of every dollar-denominated asset you hold. The only variable is whether you're on the side that sees it coming or the side that does not. So we're here, February 6th, 2026, 2 days before Japan's election, 48 hours before markets reopen on Monday and react to whatever outcome emerges. The bond market has already broken. Stage 3 is complete. Stage 4, the contagion phase, is active and accelerating. And here's what the historical record tells us with uncomfortable clarity. Once Stage 4 begins, it doesn't stop until a resolution is forced. Either through massive coordinated central bank intervention that temporarily restores confidence, or through default, restructuring, and system reset. There's no middle path. There's no gradual normalization back to calm markets and stable yields. The sequence completes. The United Kingdom's crisis resolved through emergency Bank of England intervention and political capitulation. Truss resigned. Policy reversed. Markets stabilized, but only after significant wealth had already transferred. Greece's crisis resolved through default, bailouts, and a depression that lasted years. Japan's crisis in the 1990s never truly resolved. They papered over the problem with 3 decades of deficit spending and monetary suppression, which is why we're here now watching the accumulated pressure finally break through. This time, the intervention that would be required to stop the cascade is unprecedented in scale. The Federal Reserve, the Bank of Japan, the European Central Bank, probably the Bank of England, all coordinating simultaneous balance sheet expansion. Synchronized rate cuts despite inflation concerns. Emergency currency swap lines, direct purchases of each other's government bonds. The entire crisis management toolkit deployed at once across multiple continents. And even if that intervention comes, even if central banks pull out every stop, it doesn't erase the losses that have already occurred. It doesn't change the fact that bond portfolios have lost value as yields spiked. It doesn't reverse the equity repricing that's already underway. It doesn't restore confidence in sovereign debt sustainability. It just buys time. And time bought through monetary intervention comes with a cost. Inflation, currency devaluation, and the erosion of purchasing power for everyone holding cash denominated in those currencies. The election on Saturday doesn't solve this. If Takai's party wins, she pursues the expansionary fiscal policy she campaigned on. More spending, suspended consumption taxes, more debt issuance. Bond markets react negatively because the trajectory is clear. If her opponents win, they're promising similar policies with different branding. Either outcome results in more supply of Japanese government bonds hitting the market, which means yields stay elevated or go higher. The mathematics are unforgiving. Japan's debt to GDP is 237%. That number doesn't change based on election outcomes. The interest cost at current yields is approaching unsustainable levels. That reality doesn't shift because a different political party takes power. The bond market's rejection of fiscal credibility doesn't reverse without actual fiscal reform, which isn't coming. So here's what you're actually looking at over the next few weeks. Monday, February 9th, markets reopen after the election. If Japanese yields stay above 2% on 10-year bonds and approach 4% on longer maturities, the crisis is confirmed as structural, not temporary political noise. Foreign investors accelerate their exit from Japanese assets. The yen continues weakening, which imports inflation and forces the Bank of Japan into an impossible choice. Defend the currency and let bond yields spike further, or let the currency fall and accept inflation that erodes purchasing power. Mid to late February, the contagion broadens. US Treasury yields push toward 5% on the 10-year. European bond yields follow higher. Credit spreads in corporate bond markets widen significantly as financing costs rise and default probabilities increase. Equity markets experience corrections of 10 to 15% as valuations compress. Real estate transactions freeze as mortgage rates spike and buyers disappear. March, the resolution phase begins. Either coordinated central bank intervention succeeds in stabilizing markets at lower levels, meaning the losses are locked in but further cascade is prevented, or intervention fails, and the crisis deepens into a full systemic event requiring unprecedented measures. The pattern is clear. The mechanism is understood. The transmission channels are active. What happens next isn't mystery. It's mathematics playing out through market structure. And your position in that structure, what you hold, what you've sold, where you've taken refuge, determines whether you preserve wealth or watch it evaporate. There's a reason this channel exists, a reason we dig into the mechanics of how money moves, how empires restructure, how wealth transfers from those who don't see the pattern to those who do, because the pattern repeats. The crisis architectures are similar. The outcomes are predictable for anyone willing to look at the data without bias, without hope, without the assumption that this time will somehow be different. Japan's bond market didn't break because of bad luck or temporary political noise. It broke because 30 years of accumulated debt met the mathematical reality that exponential growth in borrowing eventually exhausts the capacity and willingness of markets to finance it. The break was inevitable. The timing was uncertain. But the outcome was written into the structure the moment Japan chose intervention over correction back in 1990. And the contagion spreading to global markets right now isn't happening because of panic or irrational fear. It's happening because $1 trillion in US Treasuries held by Japanese investors are being liquidated as those investors repatriate capital to buy higher-yielding domestic bonds. Because rising risk-free rates mechanically reprice every asset class lower. Because leverage that worked at 2% interest rates breaks at 5%. The empire isn't collapsing, it's restructuring. The rules that governed the past 30 years of monetary policy, of deficit spending, of yield suppression, those rules are being rewritten right now in real time. And the only question that matters is whether you understand the new rules before they're fully implemented. Because by the time everyone understands, the repositioning is over and the losses are locked in.